Investing in commodities offers a unique opportunity to diversify your portfolio and hedge against inflation. On today's program, we'll tell you about one commodity ETF designed to capture income on gold. Plus, we'll reveal the name of a top-performing commodity ETF with a 5-star Morningstar rating. Stick around. I'm Jacqueline Schadeck with ETF Guide, and it's great to see you again. Before we go any further, just a quick reminder that Spotlight is available on major video streaming platforms like Apple TV, Amazon Fire, and Roku. Plus, you can find us on major podcasting platforms like iTunes and Spotify. Commodities have been a standout performer and are starting to get some well-deserved attention. Over the past 3 years, the Morningstar 5-star rated USCF Summer Haven Dynamic Commodity Strategy No K1 fund, ticker SDCI, has gained almost 50%, easily beating the S&P 500 along with bonds and real estate. So what's ahead for commodities, and how can potential investors participate in their growth potential? Here to discuss that and more is John Love, the CEO of USCF Investments. Hi, John. Welcome to the show.
Hi. Thank you for having me.
Excited to have you here. Now, politics have a big impact on energy policy and commodities. And here in the U.S., some analysts expect the incoming Trump administration to ease federal regulations for the oil and gas industry. What effect might easing regulations have on oil and gas markets, along with ETFs linked to them?
Sure. Well, I mean, any easing of regulations, it's going to make it easier for the oil companies, the fossil fuel companies, to do business. What's interesting is Trump, one of his big campaign promises, or one of the things he kept saying in a very pithy way, was drill, baby, drill. And he says he's going to do that on day one. The only thing about that is the oil producers are already pretty much drilling as much as they want to drill. They've been very disciplined this decade. They've been very focused, and we are at record highs in terms of U.S. oil production. So he might make it easier to do a little more, projects, and over the longer term, perhaps allow oil companies to drill in new areas. That'll make it easier. Maybe move to more profitable wells. That will make it easier. But in the short term, there's really not a lot that can be turned on. And if we did, there's some implications to that as well. But what's interesting right now is the backdrop for this whole thing, which is, over the last couple of years, several years, OPEC has been in a price defensive mode. They do not want the price to sink. And production has gone up in the U.S. Production has gone up in Brazil and other countries, non-OPEC countries. And they've essentially had to say, all right, the price is more important to us, so we're going to do voluntary quotas. We're going to have agreed upon cuts. And they've been very fierce about implementing and keeping those in place. In June of this year, they said, all right, we think the time is up. The economy's has recovered. Global economy is pretty good. We're going to start unwinding these cuts. And they've delayed it. And they've delayed it again and again because they're watching the data. Growth out of China has been slow. Other areas, there's positives, but they've really been defending that price. What Trump may do on the international stage, probably, I know he wants to do, is take Iranian barrels off the market. And depending on circumstances, maybe some Russian barrels. I wouldn't hold my breath on that, but that's possible that circumstances develop where that's a possibility. But taking Iranian oil barrels off the market potentially gives OPEC the ability to release some barrel to make up for those barrels with their own, the cuts that they've been wanting to unwind. Long story short, I think they're going to wait till those barrels come off and maybe the price goes up. They'd much rather expand their supply when the price is higher than lower, because that will lower the cost. But the short answer to your question is I think in the short term, there's not a lot that the incoming administration can do that's not already being done. U.S. has a very healthy energy sector, and it's continuing to be healthy. And I'm sure it'll be great for the companies in terms of being able to conduct business. But on the short term, it's not going to have a huge effect, not nearly as much as developments on the international stage will have.
As you know, John, this year, the USCF Midstream Energy Income Fund, ticker UMI, has been among your firm's top performers. Not only has UMI gained over 40% since the start of the year, but it's beaten the S&P 500 energy sector by a significant margin. What type of investor might like a fund like UMI appeal to?
Sure. Well, over the last couple of years, it's been terrific. The performance in this space and of this particular product, which is actively managed, it's been really great to see. But I think it's more of a long-term play. You don't always have years where you're up 44%. There can be down years, but this is a fund that provides a couple of things. One, it's for investors looking for income, and not just income, but income that is growing, has the potential for growth, an income that is diversified from other sources of income, because this is coming from midstream energy, not from treasury, what the Fed is doing or what companies' balance sheets are doing. This is coming from the revenue from midstream energy companies, which is diversified from all those things. So that income on a dollar basis has been rising over the last several years. As I mentioned before, while midstream is not oil producers, nevertheless, there's a lot of discipline. These are good companies. And UMI, like I said, is actively managed. So the portfolio managers screen for good companies. So its income is one, diversification of that income from other income sources, high current income, and hopefully growing income. The other is diversification in general. This is not, as you mentioned, it's done much better than the S&P and the S&P energy sector. It's diversified from quite a few other things, and it isn't even perfectly correlated to energy prices. Energy prices can be doing one thing, and these companies can still be profitable. And the last thing is, just good companies. Somebody who wants to own good companies. That is what we are trying hard to do. Is have a portfolio that has all those attributes that I mentioned, but also owns good companies, and that's the goal there.
And a recent edition of the Wall Street Journal published an article titled "How to Start Investing in Commodities." It suggested that a diversified, broad-based commodities ETF could be a good approach for many investors. By the way, that diversified strategy sounds like the USCF Summerhaven Dynamic Commodity Strategy No K1 Fund, ticker SDCI. The fund also has a top 5-star Morningstar rating. John, can you tell us more about SDCI?
Well, you're right. That article does describe us. It is a broad-based commodity fund. I think when investors think about commodities, they often think about the individual commodities. We've been talking about oil. People often think about gold. Broad commodities is really almost a different asset class from any single commodity. Those are, gold, some people consider our precious metals an asset class in itself. Energy, obviously a sector. Or a sector in equities, and also a sector within commodities. But a broad commodity fund gives you exposure to things that you don't normally probably think about, but you use every day: cocoa, cotton, coffee. And there's different times that these different commodities have potential to earn positive returns. So what we do is, I think the secret sauce is essentially giving you strong beta to commodity benchmarks like the Bloomberg Commodity Index, the GSCI Index, which has a little higher weight to energy. So a traditional commodity exposure. But what we don't do is hold every single commodity all the time. We always own every commodity sector, but we don't always own every commodity. We use a methodology that chooses commodities that we think are more likely to be in short supply relative to demand. And if that's the case, then those commodities are more likely to rise in the future. So while we're giving you that strong beta to the commodity space, I think we've got about a 90.9 beta to the Bloomberg Commodity Index, we're outperforming by a wide margin. And that's because we're selecting the commodities on a dynamic basis. We do that every month. We rebalance to equal weights every month. And we're looking for that signal that tells us that something is potentially in low inventory. And so that's worked out really well. We are, year to date, quite significantly above most of the other commodity ETFs that are out there that are tracking the traditional indices. And that's true over 3 years as well. So, and in fact, if you look at the index that the fund tracks, that index over the long term, that's true as well. So we're really happy with it. And I think this product, as you mentioned, it gives you diversification again from stocks and bonds. It's something great to hold in a year like 2022 when both stocks and bonds were down, commodities were up, SDCI had a great year. So it's something we think is a long-term thing, and it's different than oil. It's different than gold. It can hold those commodities, but it holds many things that are not correlated with oil and gold as well, giving you a lot more opportunities within the space.
You mentioned gold. Let's shift to one more final question before you take off and talk about gold a little bit. As you know, gold has been trading near all-time highs, and the USCF Gold Strategy Plus Income, ticker USG, takes a unique approach to investing in gold. Unlike most gold ETFs, USG offers income potential. How does USG work, John, and how might the fund be deployed inside a diversified portfolio?
Sure. Well, I think the way to look at this product is it's somebody who wants exposure to gold and wants to do it through a gold ETF, but knows gold does not produce income. And they would like to have some income in addition to the gold. So it's basically, you want that gold exposure. I also, hey, as long as I'm buying and owning gold and it's sitting in my portfolio, let's earn some income. So the way that works is we sell covered calls on our gold positions, and when those typically earn premium for funds of this type of strategy. And the way it works, if the market is down, if it's flat, or if it's trending up but not too quickly, then you typically would outperform on a total return basis the underlier, which is gold in this scenario. In a runaway market like we've actually had during a big portion of this year and over the last a little longer, gold itself, sometimes you hit those covered calls and the fund trails a little bit on a total return basis, but it's still putting out that premium from the income. And it's still very, very highly correlated to gold. And over the long term, these kind of strategies tend to outperform and give you two things in one: gold and the diversification and security gold provides for people, and a little bit of income along the way.
Good, awesome. Can be a great addition to someone's portfolio. And thank you for stopping by today, John. And we'll see you again soon.
Thank you very much. Great to be here.
That does it for today's episode of Spotlight. If you enjoyed the show, tell us in the comment section below by hitting the like button. To learn more about the investment strategies and the ETFs we discussed on today's program, be sure to visit USCFinvestments.com. I'm Jacqueline Schadeck with ETF Guide. Thanks for watching. We'll see you next time.